Comes down to brass tacks, it's all about the health of India Inc. Are our top corporates performing? What is the profitability of companies that we're seeing? Over the last few weeks, apart from global stories or global market movements that have greatly influenced domestic markets in India, the other big driver has been quarterly numbers. Now we're done with this season with Q2, but we need to look at the quarter gone by and what is the rest of this financial year and Q3 looking like. To do this, I have with me Gautam Duggad today. He's Head of Research Institutional Equities at MOFSL, who is very kindly joining us at the fag end of his Diwali break. Gautam, thank you so much for speaking with us today on BQ Prime. In the middle of a break, but we had to trouble you because your report on what Q2 looks like is the definitive one everyone waits for. So let's start with your sort of top takeaways of what this quarter looked like.
Thanks. Good afternoon, Tamanna. Good to be here. Wishing all of your viewers belated Diwali wishes and the season's greetings. So, yeah, you rightly said the corporate earnings are what ultimately determines the direction of the market. And this quarter has been an excellent one. In fact, I would go ahead and say this has been the best quarter in the last 5-6 quarters. There are 2 or 3 reasons why I say that. First things first, the aggregates have beaten expectations across the board. We've seen a 48% earnings growth for our coverage companies to 44 companies versus expectation of 40%. For Nifty 50, we have seen an earnings growth of 28% versus our expectation of 21%. And then if you do all kinds of cuts and analyze, X commodities, X financials, or X of OMCs, whichever set of aggregate you take, the earnings have beaten expectations. Second, the more important thing is the beat has been across the board. So if we make estimates for 21 sectors, out of that, 19 sectors have delivered numbers which are better than expectations or at least in line with expectations. There are only very 2 small sectors which have missed expectations, right? So this has been as broad and as you can say the most inclusive quarter that I have seen in a while, where every sector has come to the party. And third, we have seen earnings upgrade, right? At the beginning of the quarter, when we had done the preview and interacted with about 50-60 investors on the institutional side, one of the questions which kept coming to the mind recurringly in all my investor meetings was the first quarter was a very good quarter. Nifty earnings had grown 32%. This quarter, we are building in 20%. Is there a risk? Because some segments of the economy were showing muted trends. But yeah, the quarter is coming pretty well, pretty good, 28% growth. So, and on top of that, we've seen earnings upgrade of about 1% each for FY24 and 25. So our EPS for Nifty FY24 now stands at 996 rupees versus 986 at the beginning of the quarter. And for FY25, it stands at 1140 rupees versus 1132 at the beginning of the quarter. So all in all, a very good corporate earnings season. And if we continue to see this kind of delivery in earnings, our full year expectations are now at about 21% earnings growth for FY24. It will essentially mean that Nifty is looking reasonably valued at 17.2, 17.3 times FY25 EPS. So that's my broad top-down takeaways from the second quarter numbers.
All right, let's get into a little more detail about the sectors, the groups of companies that really fired. Auto, BFSI and cement. Now I'm speaking to you on a day where BFSI, or at least the banking financial space, is in the middle of a maelstrom. Everyone's trying to figure out what's happening there. Since we saw the pressure on margins to some extent in the financial space, cost of funds have increased. How do you look at these latest developments from the Reserve Bank of India, which is very clear? What they are targeting is unsecured personal loans and credit card outstanding. How do you see that impacting the space in the context of their performance in Q2?
So performance has been solid. Look at the financials, whether private bank, PSU bank, NBFCs, non-lending NBFCs, all aggregates, all cohorts of financials have beaten expectations. and they've been performing very well for last 4 or 5 years. In fact, if I take you a step back, the financial earnings had bottomed out in FY18, and the 11 financial companies which are part of the Nifty, their combined earnings that point of time was 45,000 crores. Today we are talking about the same companies delivering 2.5 lakh crore of earnings in FY24 and hitting almost 3 lakh crores in FY25. So this is a very broader view. In the context of what happened yesterday, the regulation, the RBI circular is very clear. I mean, they've been making this noise about unsecured and cautioning the players for some time now. I think they waited for the Diwali and festive season to sort of get out of the way before they come and announce this step. This will definitely have an impact, more so on some of the segment-specific NBFCs. Banks, I think, relatively more cushioned in that sense, given that they have a far bigger balance sheet and they're very well spread across the board, right? And that is what the market's reaction today is also telling you. But you have to wait for a couple of months and see how the companies and the players in those segments react to this new directive, whether they cut down on loan growth, whether they raise more capital, they pass on the higher cost, which they will now obviously be increasing as far as the interest rates are concerned. Will they pass it down to the borrowers or not? We'll have to see, because different companies will react very differently, because the product mix is very different for each of the company which is part of the NBFC basket. As far as we are concerned, we're very clear that those companies where the growth visibility is the strongest, we have a huge allocation to them in our model portfolio. Second, the valuations. It has become very cheap. The banking sector, if you look at the last 2.5 years, has been a rank underperformer. And therefore, by virtue of that, the relative valuations that banks are trading at today are mouth-watering. Large cap private sector banks, even PSU banks like SBI, Bank of Baroda, all of them are trading at a very reasonable to cheap kind of a band. Once this thing is out of the way, I think people will again flock back, because the growth is still looking reasonable there. We're still talking about 20% earnings growth in financials on a very high base, which is already expanded 5 times in 5 years as far as profit pool is concerned. So yes, there will be hiccups along the way, but in an overall context of the things, the growth versus valuation equation is very favorably placed for large cap banks today.
Yeah. Just one more follow-up on this particular topic, because today, of course, you are seeing banks broadly getting hammered, but some more than others. Which are the counters you think most likely to be impacted by these, and what would be perhaps your picks, which would be a buy on dips play right now, where this mood is a little negative?
So Tamanna, we have been very clear in our model portfolio. If you see our model portfolio, you will notice that for last 2 years, we've had a huge overweight on PSU banks, right? We had Bank of Baroda. We think that for the kind of ROEs that they are delivering right now, banks are still available at below one-time price to book, maybe X of SBI. Even private sector banks like ICICI, HDFC Bank, the valuations have come up drastically. So there is a lot of options available, and given the relative correction in valuation multiples over the last 2 years, it's actually a very good bouquet there. And also we have SBI Bank, we have HDFC Bank, ICICI Bank. We also hold AU Bank and ICICI IndusInd in our model portfolio. But most exciting part of the financials is the non-lending NBFCs, which is where we've been very lucky. We added Angel a month and a half back when the price to earning multiple was hovering around 14 times. In the last 45 days, the stock is up 55%. And now the valuations are at about 20-21 times. We still like the net because the underlying operational parameters is still very robust. But our preference is PSU banks, NBFC, private banks, and of course, a very separate allocation for non-lending financials. So that is how the overall architecture of BFSI overweighting is divided.
All right. Let me just go a little forward looking. Which are the spaces that you see really going to fire? And of course, you've spoken about OMCs. We've spoken about autos, and these are going to be exciting. But I just want to also add to that pack and your view on the real estate space. Again, done very well on earnings. As per your report and review as well. Do you see that buoyancy continuing? And if we had to go one layer deeper and say what would be your top picks in some of these spaces, the companies that look poised to take that growth further, what would you say?
So in consumption, we have a distinct bias towards discretionary. So we hold 8 stocks in our model portfolio belonging to consumption, out of which just one is stable, which is ITC. The rest 7 stocks are discretionary, within which our topmost idea for almost a decade now has been Titan. Right? Aside of Titan, we hold Indian Hotels, Zomato, DMart, Metro, Lemon Tree, and Kajaria. So there is a whole host of discretionary, segments which we are positive on, because we believe that the growth runway there over the next 3 to 5 years is much superior compared to what is available for consumer staples. Because in consumer staples, your penetration levels are already hitting 80-90% in many of the categories. Second, in real estate, you're seeing, actually there are 4 or 5 sectors where you are seeing an upturn happening after a very long time. So if you look at real estate, hotels, and industries, there are 3 segments where upturn is happening after 10 to 12 years. And we are now in the 2nd or 3rd year of an upturn for hotels and real estate. I think this can last much longer, specifically hotels and real estate, because the affordability has gone up significantly for real estate market, because the prices have been flat for 10 years, interest rates are very benign even now, and the disposable incomes have grown. Second, in hotels, what is happening is supply is not matching pace with the demand, right? So your demand is growing at about 7-8%, while supply is growing at 2-3%. So again, the fundamental drivers of hotel business are very favorably placed. Industrials, which has already seen a huge rally in the last 2 years. I mean, I had done one study 2 months back when I was looking at the 100 industrial stocks of India in the descending order of market cap. The market cap used to be 7 lakh crores in July 2020. That has now touched 23-24 lakh crores. So that's how sharp the rally has been in industrials. But we are still in a cycle where private capex is yet to fire at full pace. So possibly this can continue for some more time after taking a breather. And lastly, hospitals. This is again a sector which was not in the reckoning about 5-10 years back because there were not many listed plays. Today, you have about 10 hospital companies which are available, out of which 3 we are tracking, and we are positive on both Max Health, Medanta, and Apollo, and their numbers have been very solid. Plus, their underlying operational parameters like ARPOB and bed addition, all of that is operational efficiency. They're doing quite well in that sense. So these are 4 or 5 sectors where you're seeing upturn happening after a long time and possibly sustaining. I'm obviously not mentioning auto because that I've already highlighted. It has been the best performing sector in terms of corporate earnings, 5th quarter in a row this time.
Yeah. I just want your take on some, I would say, positive, not surprises, but definitely some positive news and the interest in PSU plays. Coal India, we saw just a great set of numbers and a very good response there. ONGC, what's your take on that? SAIL, Hindalco, some of these plays. How would you play the government-owned PSU space right now?
So, see, both the names you mentioned, Coal India and ONGC, in fact, if I remember well, at the beginning of CY23, we had put out ONGC as part of the top 10 ideas for CY23 in January 23. Right, that stock has obviously done well, but it is still available at what 5 times P, and dividend is extremely strong. Coal India happens to be our number 1 preferred idea in the metal sector. There you have a good 7-8% dividend yield. In fact, the underlying parameters for the power sector, the thermal power generation, all of them are very favorable for Coal India right now, plus their production, dispatches, the EBITDA pattern, whichever number you look at for Coal India, and plus obviously valuations, they're still very cheap. Coal India is up, what, 40-50% in the last 3 months, I guess. But even now, the PEs are very, very cheap, I would reckon, given the underlying dividend yield and visibility for next 2 years of earnings in Coal India. So, luckily, you mentioned both the names, which we like.
So, what is your ideas for H2? A lot of the companies we spoke to, especially in the consumer space, talked about they're expecting a better H2. Some of them was because your festive season fell in H2, etc. But if I were to ask you your top 3 ideas for H2, what would be your answer?
So one has to be title because, as I mentioned, it is really doing well in terms of the underlying volume growth as well as new customer addition that they are doing. It has been a top idea for us for almost a decade, so I'm just continuing with it because the underlying performance merits it. Second one, which I like again, is M&M. Very reasonably priced. The core price to earning for FY25 is below 15 times now, and both SUV as well as tractor have been performing fairly strongly. Whether you look at margins, whether you look at the underlying numbers on a monthly basis. And third name, which I want to highlight because we are now getting into an election season, is L&T. Obviously, it's done very well. It's the single largest overweight for us in industrials. The numbers were solid for this quarter. The guidance that they've given looks very conservative. I think they will easily beat their guidance for FY24 in 2H FY24. These are the large cap which I mentioned. In mid caps, what we like Angel Broking, we like Medanta Hospital, we like Metro Brands, we also like Ashok Leylands. So these are all part of our model portfolio already. I'm just highlighting some of them because you specifically mentioned the place for 2H FY24.
All right. Pleasure speaking with you, Gautam. Thank you for taking out the time and talking to us today.
Thank you. Thanks, Tamanna.